For nearly 2 decades, the most consistent investment fund on Wall Street reported a profit almost every single month, through crashes, wars, and recessions. Behind those perfect returns sat a secret that is almost unbelievable. The fund never made a single trade, not one. This is the story of Bernie Madoff. $65 billion on paper, the largest Ponzi scheme in human history, and the 5-minute math proof that regulators ignored for 8 years. By the end of this file, you'll understand how a Ponzi actually works, like a lesson on a board, where the $65 billion actually went, and why the watchdogs missed it again and again. This is Vanished Billions. Open the file. Bernard Madoff was not an outsider. His firm helped pioneer electronic trading. He served as chairman of the NASDAQ stock exchange. When he spoke about markets, regulators took notes. His investment business lived on the 17th floor of a Manhattan tower. Getting in was a privilege. He turned people away, and being refused only made them beg harder. Country clubs whispered his name like a password. The returns were the product. 1% a month, 10 to 12% a year, never a losing year. A line that only went up at a perfect, gentle, impossible angle. The habit was older than the empire. Back in 1962, a young Madoff lost his client's money in a market break, quietly borrowed cash, and covered the losses so his record would look unblemished. Investigators would later point to that moment. The lesson he took from his first failure was not honesty. It was that a clean-looking record is worth more than a real one, and that nobody checks a winner. So let's do what the regulators never did, and go to the board. A Ponzi scheme has only 4 moving parts. New money comes in from new investors. Old investors are paid so-called returns out of that new money. The statements call it profit. And in reality, there is no investment happening at all. The machine survives only as long as more money walks in than asked to leave. Madoff's version claimed a strategy with an expensive name: split strike conversion, blue chip stocks protected with options, sophisticated enough to sound real, vague enough that nobody checked. The reality lived on one aging computer. On the 17th floor, a small team fabricated trade confirmations by hand, using yesterday's newspaper to pick which prices to invent. The trades were typed, not made. And where did the cash actually sit? Not in stocks, not in options, in one bank account. Money came in, money went out. The world's most exclusive fund was, functionally, a checking account. The account sat at one of the biggest banks in the world. For years, billions cycled through it with no sign of trading, no brokerage fees, no counterparties. In 2014, that bank paid more than $2 billion to settle claims that it had looked away. The red flags had a banking address. By 2008, the statements told clients they owned $65 billion. The real money that had ever come in was around $20 billion. The other $45 billion existed only as ink. And one investor understood the machine better than anyone. Over the years, he withdrew more than $7 billion of fake profits, far more than he ever put in. After his death, his estate returned every cent in the largest forfeiture in American history, $7.2 billion given back with a signature. In 1999, a quantitative analyst named Harry Markopolos was told to copy Madoff's strategy. He later said it took him 5 minutes to see the truth. Back to the board. Real markets wobble. Every real strategy has losing months. Madoff's line climbed smoothly for decades, and the options market wasn't even big enough to hold his claim positions. The returns could not exist. Markopolos did not stay quiet. He wrote to the regulator in 2000, again in 2001, and again in 2005 under a title nobody could misread: "The world's largest hedge fund is a fraud." The regulator looked at Madoff more than once. It asked questions, and it accepted answers. What it never did was the one check that ends every Ponzi, confirming the trades with the exchanges. There was nothing there to confirm. In 2006, the regulator even opened a formal investigation. Madoff sat across from investigators and lied about who held custody of the assets. They caught him in that lie. Then they closed the file anyway. The Inspector General's report on this reads, to this day, like an autopsy of institutional deference. Why did smart people not run? Because everyone was earning. Feeder funds collected fortunes in fees for the introduction. Charities parked endowments. Retirees parked lifetimes. Doubt was expensive, and belief paid out monthly. By the 2000s, the machine had gone global. Feeder funds in New York, Geneva, and Vienna gathered billions from clients who often had no idea Madoff even held their money. The feeders collected hundreds of millions in fees for the introduction, and some asked remarkably few questions on the way. Checking was bad for business. The entire pipeline was paid handsomely to believe. Then 2008 arrived. Markets collapsed and frightened clients asked for their money back. $7 billion of withdrawal requests hit a fund holding a fraction of that in actual cash. The arithmetic from the board finally came due. On December 10, 2008, Madoff confessed to his own sons that the business was, in his words, one big lie. The next morning, the FBI stood at his door. He told them there was no innocent explanation. The people who finally stopped Bernie Madoff were not regulators, auditors, or bankers. They were his own sons. They heard the confession at home, called a lawyer that evening, and the lawyer called the government. The fraud that beat every institution was ended by a family. He pleaded guilty to 11 federal counts and was sentenced to 150 years. He died in prison in 2021. Now the ledger, and it holds a genuine surprise. The $65 billion never existed to lose. The real principal that vanished was about $17.5 billion. A court-appointed trustee then spent over a decade hunting it, clawing back the fake profits from anyone who had taken out more than they put in. He recovered more than $14 billion. Most victims eventually got most of their principal back. The returns they had lived on for years, of course, had never been real. Compare that recovery to the rest of our files. FTX customers waited years for a snapshot of old prices. Wirecard's shareholders got almost nothing. Madoff's victims, through a decade of clawbacks, recovered most of their real money. It remains the strangest epilogue in the history of fraud. The best repaid victims of the biggest Ponzi ever run. The deeper damage did not claw back. Charities closed, families shattered. A foundation built by a Holocaust survivor lost everything it had. Trust, once cashed out, stays gone. Put this file beside the others. FTX had a token. Theranos had a demo. Wirecard had profits nobody could reach. Madoff had something purer, a statement printer, and your patience. Every one of them counterfeited the same thing: verification. And the defense against all of them fits on one board. Never confirm wealth with the person who holds it. Confirm it with someone who loses if they lie. That one rule applied once would have ended this story 17 years early. New forensic files every Tuesday and Friday. The frauds, collapses, and cons the business world would rather forget. Subscribe if you want to know where the money went.